Want to say welcome to everyone who is here today. And I want to give a special thanks to William Furman with the SBA. The SBA is a tremendous resource partner for us, and they do a lot for us, and we are really excited to have William on this call with us today to talk with us about some of the lending options that are available through SBA. So as Carolyn mentioned, if you have any questions, please feel free to use the chat box and put them in there, and we will be addressing them at the end. So our topic today is how to apply for a business loan. And then William is going to give you, have a discussion of some lending options that you have through SBA. For everybody that is in business, most likely at some point, you're going to have a situation either before you start or as you're growing your business, where you're going to need potentially some financing. And so what we are here to help you do is to identify what might be an appropriate financing option for you, and then to help you get ready to do that, to actually apply for a loan. So what we're going to be talking about today is what you need to do to be ready to apply for a loan, some things that you need to think about, and what some of your different options might be. Okay, there we go. So as I mentioned, I am Paul Featheringill. I am the UofSC Region Director with the Small Business Development Center. My office is here in North Charleston. Also joining us today is William Furman, Senior Area Manager with the SBA, whose office is also here in North Charleston. So who are we? So the South Carolina Small Business Development Centers, we are a statewide network of highly trained professionals. We have over 20 centers across the state. We have over 50 counselors across the state that offer no fee individual confidential consulting. We assist both existing and startup companies. We also will conduct different either free or affordable educational workshops, things like this, and covering different topics throughout the year to provide you access to useful information and business resources. We also, in addition to working with startup and existing companies, we also have some different areas of specialization that we can assist you in. For example, marketing, importing, exporting, manufacturing, government contracting, intellectual property and patents, those sorts of areas. So basically any kind of business you have and any stage you're at with your business, if you need any assistance, we are here to help, and we can find somebody that will be able to assist you. And here you see our website, sbdc.com. You can go onto the website and you can request counseling and find the center nearest to you. And we'd be more than happy to set up an appointment to work with you. So when we talk about small business financing and small business funding, what are some different options that you have? I'm going to return to the first one in just a minute, which is grants. But some different things that you can think about would be investors, online lenders, different non-bank financing options, and I'll explain what some of those are when I get to them, and then conventional bank financing. As far as grants go, we get that question a lot as to getting a grant to start your small business. And I hate to be the bearer of bad news, but there really aren't any grants for starting small businesses. There have been some of the relief programs, such as the PPP, related to COVID, related to the pandemic, that some of them operate as grants. But in a general sense, there really are not any grants available for starting a small business. But you do have some of these other options that you can look at. One of the first questions beyond that, after where can I go to get a grant to start a business, is should I just go to my bank? And the thing about conventional bank financing that you want to keep in mind is that some of the things that they are going to look at, number one is your time in business. Most banks are not interested in financing your business until you've been in operation for at least 2 years. One of the first things they're going to ask you for as part of your application package for a loan is at least 2 years of tax returns and business financials. Another thing that's going to be a factor for a bank is personal and business credit. So if you don't have any business credit established, or you have personal credit issues, anything like that, that can be an issue with conventional bank financing. Another thing is loan amount. Sometimes if it's a smaller loan amount that you need, either at the startup phase or as you're looking to grow your business, sometimes it can be a little harder to do that. A lot of times banks aren't going to be really interested in looking at financing with you until number one, you've been in business for a while. Number two, you've established a relationship with them. So in other words, you've had an account or multiple accounts with them for a period of time. And number three, that you're looking for a larger loan amount. I mean, by the time you get up into the six figures to over $1 million, they start to get a little bit more interested. Not that there aren't banks that will look at other things, because banks have different appetites. And so, that's one of the things that we can help you do, is determine, depending on where you are and what your needs are, what some good banking options might be for you. Sometimes the big box banks aren't always the best option for small businesses, but we can help you find those who might better be able to work with you. But in general, I would say that if you've been in business for less than 2 years, conventional banks aren't really a good option for you. They're not really going to be interested in looking at you. So what are then some other funding options that you have? One route that you can go is investors. Sometimes people draw from family and friends as far as getting them to invest in their business, which is great. That is absolutely fine. One of the things that we would encourage people to do, if you do go to family or friends for investment in your business, is to have some sort of agreement, put something in writing as to, is this a grant? Is it a loan? When do you expect to get paid back? Do you expect interest? Because it can get a little bit awkward, especially around holidays, if somebody's giving you money to invest in your business and you haven't paid them back and they expected to get paid back or something. So just make sure that you have something in writing and that everybody knows what the expectations are. There's a couple of other options for investing in your business. There are venture capitalists and angel investors. So venture capitalists tend to represent larger kinds of funds or pools of money, and they are investing in businesses that have sort of longer term growth potential, higher level growth potential, and then potentially even something that they could buy down the road. So for example, looking at maybe a technology that a company is working to patent or something along those lines. Angel investors tend to be individual investors with money who are looking for companies that they can support. The thing that I would encourage you about with every funding option that's out there is to make sure that you ask questions and make sure that you know what they all entail. So for example, especially with angel investors, it's not free. It's they are going to take some sort of stake in your business, or they are going to expect you to pay back some or all of what you borrowed. So in other words, oftentimes with venture capitalists and usually with angel investors, you're either going to have a portion of that you're going to have to pay back with interest, or they're going to have an equity stake in your business, which means that they're going to have an ownership stake in your business as a result of giving you those funds. So just make sure before you get into something like that, that you kind of know what all the requirements are and what the fine print is. So online lending is something that has become very popular over the last few years, and especially you might have seen in relation to PPP and EIDL and some of the other COVID relief things that have happened recently, that a lot of these online lenders have participated in this. And these are just a few of them, kind of a random sampling from Google of the ones that are out there right now: On Deck, Cabbage, Lending Club, Prosper, Square Capital. These are all things that that people commonly use for business. What I would encourage you to be cautious of with these is to make sure that you understand how the fees are structured, what the interest rate is going to be, and how you're going to have to repay these. Okay, because one of the things that you can get into, so for example, if you go to a bank or one of the other lenders that we're going to talk about later, sometimes it can be a longer process. It can oftentimes take several weeks to a couple of months or longer, depending on the situation. But and sometimes it's a little bit more difficult process, but because of that, if you get money that way, it tends to be some of the best terms and interest rates you're going to be able to get. With the online lenders, you can typically submit an application online. You can typically get a response and oftentimes get money deposited directly into your account within 24 to 48 hours. So there's a very quick turnaround on it. They are very, forgiving of things like, credit issues and business financial performance and all that kind of thing. But the thing that you have to be careful of is that you can oftentimes end up with, when you add them together, interest rates and fees that give you an effective rate of, anywhere from 25 to 30 to 40%. And oftentimes these will be lenders that you'll be making payments to every day, directly out of your bank account. So you really want to just make sure that you're really reading the fine print and you really understand what the requirements are going to be of any financing that you get. Crowdfunding is another option. You might have heard of this in relation to some other things, and you might have heard of sites like Kickstarter and GoFundMe. Some of these are, there's a whole bunch of them out there, and again, this is just kind of a general sampling. But this can be a good option for some people. So basically, this is not taking a loan or anything like that. It's not anybody investing in your business that's going to have an ownership stake. What this is you can go on the web, you can set up a page, basically a description of your business and what it is that you're seeking financing for and how much you're seeking, and people can come and give you money. They can contribute money towards you growing your business. A lot of times, now you want to check with the individual sites, because a lot of times there will be different fees associated with this. For example, the site might keep 10% of everything you raise as an administrative fee or something like that. Other sites, if you don't raise the full amount that you're looking for, sometimes you don't get anything. They return the money to the investors. So again, just make sure, depending on the platform that you're using, to kind of know what the different requirements are. And one of the ways that this works is that people oftentimes will, when they're setting up, because if you're going to get a venture capitalist or an angel investor, they're really looking at long-term potential of your business. They're looking at, how much is this going to grow? How profitable do I think it can be? And do I think I can get some kind of longer term return on investment, or potentially a business that I could purchase down the line? These are the sorts of things that they're looking for. Crowdfunding folks, they typically are looking for something that more is, maybe has a story behind it, maybe is a little bit more interesting, something that's got kind of a catch to it. And they are also looking for options that they're also looking for. So for example, you might tell somebody, if you invest in my business, I will give you 10% off the first year of any good or service you buy from my business, or anything like that. One of the best examples I've ever seen of this crowdfunding piece, from my previous life as a lender, was a business called Pounce, which is a cat cafe over on Meeting Street, where you can actually go in and you can, get coffee or a drink or something and sit and play with cats. And you can also adopt them after you've had the opportunity to go over there and spend time with them. And the lady who started the business was looking at different conventional funding options, but just decided, hey, let me see if I can raise any money through this. And she ended up, because there's a little bit of a story to that, something that people were really excited to buy into, she was able to actually fund her entire business through crowdfunding. So it can sometimes be an option for you. And then one more. So another option that you have beyond this, so we've talked about banks, we've talked about online lenders, we've talked about crowdfunding, we've talked about different kinds of investors. There are also some alternative lenders out there, which are organizations that are geared towards lending to startup businesses, newer businesses, those who are not eligible for bank financing. There's different ones in the state of South Carolina, like and in Charleston, like the Charleston LDC, the South Carolina Community Loan Fund, Fund, Community Works, and these are different ones that many of our counselors have relationships with and can help you through the process of applying for a loan for if you are at a startup phase or a phase in your business where you're not able to apply for funding. But that's one of the things that we can help you with, as I mentioned, is to determine what might be a good funding option for you. And then, if you're looking at something and you're not exactly sure if it might be a good option for you, that's something else that we'd be happy to sit down and talk with you about and see if it makes sense for you to pursue it. So just some general things you should know where business financing is concerned. There's no such thing as 100% financing, okay? So every lender of any sort is going to want you to have some kind of stake in the game. They're going to want you to have some of your own money to put in. Typically, most lenders are going to look for 10 to 20% of your own cash to put in, and I'll talk about that a little bit more later. Personal credit history is important. If you have, most lenders are going to look at whether you're a startup business or an existing business, regardless of the kind of funding source. Most of them are going to require probably a personal guarantee from you, which we'll talk about a little bit later. And so they're going to look at your personal credit history. So it's really important. It's really important that you establish a business credit history as well. And we can talk with you as well about how to do that. Collateral is always going to be required. Okay, you are going to have to put something up as security for the loan. And we'll talk about what some of the options for that are. And I mentioned personal guarantees. Those are often required as well. So just some general things you need to be aware of as you start looking at different lending options. So what kinds of things do you need for a loan application? These are some of the different kinds of basic things that we can help you put together. Business plan, projections, financial statements. You need to have an idea of your credit history, resumes, tax documents, business financials if you're already in business, bank statements, collateral list, and I'll go through these in a little bit more detail as far as what lenders might be looking for and what sorts of things you should have available. So the first and most important thing that I'm going to encourage you to do is to have a business plan for your business. And that is something that we, as the SBDC, can help you to put together. So what is a business plan and why do you need one? So, as an entrepreneur, as someone with a lot of ideas for your business and for how you want your business to work, one of the most important things you can do is to sit down and really kind of examine all that, get it organized, put it down in a fashion that a lender can look at it and understand what your business is all about. So it precisely defines your business. It tells someone as a lender what your business is all about, what your goals are, who your customers are, who you're going to serve, what you're going to offer, and then what the financial aspect of that business is going to look like. How much money do you need to get this going? How much do you have? How much do you need to borrow? And then how is your business going to grow financially? But it's not just for lenders. It's also for you personally to help you organize your thoughts and ideas and make sure that, one, you have enough resources to get started, that you're using them properly, and that you're able to handle any kind of unforeseen complications and things that come up. And it really is a decision-making tool for your business. So what I would encourage you is, don't write a business plan with us or anyone else and then take it out and give it to a lender, get funding, and then put it in a drawer and forget about it. Really revisit it from time to time and look and see how your business is performing, and really use it as a tool to help you make sure that things are developing the way you anticipated, and if not, why not, and how do you need to go about addressing it. Clarity of thought and purpose. Can you really describe and talk about what your business is? And, why do people need it? Because, for the most part, most businesses, there is someone else that does what you do, probably, especially in an area like this. A larger metro area, no matter what you do, there's probably somebody around here that does something similar. So what differentiates your business from your competition? What is it? A unique product or service? Is it a location? Whatever it might be, what is it that makes you different from your competition? Explain your business model. So how are you going to gather customers? How are you going to attract customers? How are you going to sell your goods and services? What are you going to have? What different goods and services are you going to offer? And how are you going to grow your business? These are the kinds of things you want to describe. And then another key aspect of it is, are you really qualified to do this business? So what is it in your background or experience or history that leads us to believe that you're qualified to conduct this business? And if you don't have all of the background knowledge and experience and information that you need, do you have any partners or outside resources that you're bringing in that can help you do those things? And then analyzing your market and competition. So again, how do you differentiate yourself from your competition? Why will customers come to you and not somebody else? And then what we call a SWOT analysis, which is strengths, weaknesses, opportunities, and threats. And as I said, these are all things that we can help you put together. How much money do you need to start this business? What are your funding needs? And then how are you going to use the funds? And then tell us how your business is going to grow financially. How is it going to grow to the point where, not only can you repay your loan, but it's a profitable business. So then what do lenders look at to determine whether or not they are going to lend money to your business? So there are, traditionally when you talk to lenders, they're going to talk about what are called the 5 C's of credit. And this is what they are: character, capacity, collateral, capital, conditions. These are the things that lenders are going to look at in determining whether or not they want to lend to your business. And so I'm going to talk a little bit more about what each one of these things is and what specifically lenders are looking for. When we talk about character, basically there's 2 different aspects of that. One is credit history. So most lenders, all lenders are going to look at your personal credit history. Most of them are going to have different kinds of standards for what they're looking for as far as credit score and things like that. In general, I will say that for most banks, most conventional banks, for lending, they are going to be looking for a credit score of generally 680 and above. Some of them might go a little lower. Some of them might go down to 640 or so. Most of them are going to be 680 and above. Some of the alternative lenders that I mentioned to you, they might be a little bit more flexible, be willing to go down to 600 or maybe even a little lower than that. The primary thing I would tell you about credit is, number one, make sure that you pull your credit report every once in a while. You can go to freecreditreport.com and see what's on it. Make sure that you know what's on it and that everything that's on there is accurate. And make sure that before you go to borrow money, especially, you know what's on there, because if it's something that, you've got some kind of collection, you've got a past due bill, you've got anything like that that's causing you credit issues, that's something that can be taken care of, that can be repaired before you then go to apply for money. The other thing that goes into this is kind of what I mentioned earlier as far as your qualifications. Everybody has something that they're passionate about doing, and that's why they want to go into business, whether you are whether you're a chef, whether you are selling a product, whether you are, whether you're operating a salon or a spa, whatever kind of business you have, you're going into that business because you're passionate about it, you're good at it, you think that you can draw customers to it. But there's certain other things that you have to do as a business owner, like, managing your financials, managing employees, hiring people, paying taxes, all of these things that, regardless of the kind of business, that you have to be able to do. And so one of the things that you're going to have to identify to a lender is, what are your qualifications, your background? Have you managed people before? Have you run a business before? And if you haven't, if you don't have this experience, do you have a partner, a resource, somebody that you can bring in that can help you do these things? Another part of this, when we talk about financials, is your personal financial statement. Most lenders are going to request one of these, and I just give you an example of this. We will, as we'll tell you about a little bit again at the end, we will share these slides with you so that you can have this information. But I just wanted you to get an idea. If you've never filled one out before, your lenders will have one of these that they'll require you to fill out as part of your personal financial history. There's templates for this online. We can help you with some if you want to work on it ahead of time. But basically what this is it's just a layout of what are all the assets that you have? What do you have cash in the bank? Do you have retirement funds? Do you have real estate? Do you have stocks and bonds? The other thing, and then so what's the value of all of this stuff? And so that's the amount of your assets. And then how much do you owe on all of this stuff? Credit cards, car loans, student loans, mortgages, whatever it might be. So that tells you what you owe. You subtract what you owe from what you have, and that is your net worth. So why does a lender care about what your net worth is? Well, I mean, there's a couple things that they're looking at when they're looking at this. One is, do you have any cash or resources on hand that you can invest into the business? Remember I mentioned that you've got to have some of your own money to put in. They're also looking at the amount of debt that you have. So in other words, if you have a bunch of credit card debt and things like that, even if you're paying it on time, that can be a concern, because how are you going to take on this additional debt if you already have all this other debt? And then they're also looking for, is there anything on here, real estate, vehicles, retirement funds, anything like that that could potentially be used as collateral or security for the loan. So we've gone through credit capacity. So if you're an existing business, are you making enough money that you're able to pay your bills when they're due? Do you have any cash left over? Okay, so in other words, are you able to pay your bills and have a little bit of money left over at the end of the month that you can roll over into the next month? Now, if you're not already in business, that's where your personal financials become really important. And it becomes an issue of, do you have any outside resources that you could repay the loan if the business isn't successful or takes longer to grow than you think and isn't able to pay the loan? And this is where oftentimes they'll look for outside sources of income. And it could be a spouse, it could be a family member, it could be a friend, it could be another business. Somebody that's willing to sign on as a guarantor onto this loan, that they will repay it if you don't. So something else you want to think about when you're looking at a loan, when you're looking at going to apply for a loan. So we've already said you need to think about your own personal experience and you need to think about your own personal credit situation. You also might want to think about, do I have anyone else that's got outside income and resources that could sign on to this loan? Again, as I said, friend, spouse, family member, other business, whoever it is, you might not need it, but these are all things that you kind of want to have lined up before you go to apply for a loan, so that if you get asked the question, you're prepared for it. Part of this, and I'm not going to go into a whole lot of detail on this because I could do a presentation just on this, is that most lenders are going to want to see projections. So in other words, when we talk about capacity and can the business repay the loan, what lenders are going to want to see is, if you're a startup, in addition to, do you have personal resources that can repay the loan, they're also going to want to see, do you anticipate that the business is going to grow quickly enough that you can repay the loan? And so what they're going to want to see is 3 years of projections, typically monthly, of, profit and loss. So in other words, what are you going to make? What are you going to spend? Are you going to be profitable year to year? And then also cash flow. How much cash do you have coming into and going out of the business each month? And is it enough? Do you have enough cash coming through the business to be able to support the business while it grows? And bear in mind that if you're going to get business funding, that's one of the things, working capital to help you with cash flow and to have enough to grow and get through growing your business is something that you can look at as part of your loan package. And there's a ton more to this. As I said, I could do a presentation just on that, but we can sit down with you and help you put your projections together and give you a little better idea of what that looks like. So collateral, lenders have to secure themselves in terms of what happens if you don't pay the loan back. And so one of the options they're going to look at is collateral. So a lot of times they will ask you for different kinds of hard assets, things like real estate, vehicles. For things like that, they're often looking to see is, do you have any equity in it? So do you have any equity in your home? or do you own your car outright, or something like that that we can use as security for this loan. Personal guarantee, we've talked about these. This is another option for something that can be used as collateral. If you don't have real estate, if you don't have vehicles that you own free and clear, if you don't have retirement funds, if you don't really have anything like that that you can use as collateral, you can also look at, do you have a personal guarantor that you can bring that could bring some strength to the package. And again, I mentioned these are some examples: real estate, vehicles. Oftentimes lenders will take liens on your FF&E, which is your furniture, fixtures, and equipment, and inventory oftentimes of the business. And then personal guarantees, guarantees from outside sources, sometimes even outside businesses. Capital. So this is where we're looking at, what have you put into it? How much have you put into the business? And as I mentioned earlier on, there's no such thing as 100% financing. Every lender is going to want you to have some kind of skin in the game. They're usually going to want a minimum of at least 10 to 20%. So in other words, if you need $100,000 to start the business, they're going to want to see that you have at least $10,000 to $20,000 to put in, and then the lender will make up the rest. Now, some lenders will look at prior investment. So in other words, if you're an existing business, or even if you haven't started up, but you've already invested some money towards your startup in terms of, purchasing equipment, purchasing inventory, anything like that, a lot of times that can count towards your investment. But in either case, but I would also be mindful of the fact that a lot of lenders are going to want you to have some of your own actual cash on hand. And so you want to be prepared for that. You're going to need to have at least something to put in. So, if you're thinking about starting a business, in addition to keeping an eye on your credit and making sure that that's in good shape, another thing I would strongly encourage you to do is to start saving your money so that you have some of your own to put into the business. And then this is where also lenders will ask for your business financial history, current financials, balance sheet, cash flow statement, and we can help you figure out how to put those together so that you can show how much your business has made, how much it's spent, what the investment has been, and those sorts of questions. And then lastly is conditions. Basically, this is just talk about your industry, talk about your products or services that you're offering, and then talk about the market related to those things. Is it a growing market? Is this something, for example, if you are thinking about, selling something online, breaking into e-commerce, you're going to want to look at the market for that and be able to show that, this is a growing market. This is something that people are actually buying online. Talk about how you're going to deliver your services. Seasonality is the idea that, regardless of what kind of product or service you offer, there's going to be some times of the year where business is going to be better than others. And so are you kind of aware of that? Do you know, which parts of the year are going to be your strong months, which ones are going to be your weaker months, so that you can be prepared for that? A lot of people say that they want to purchase real estate to start their business. Oftentimes, I don't suggest that, just based on the fact that a lot of times it makes a lot more financial sense to rent until you're able to grow your business. But that's something we can help you figure out. And then, does your location make sense? So in other words, if you're looking to open a coffee shop, you might not want to open directly across the street from a Starbucks. Those are, there's some location things you want to think about, and also who is your competition and how do you differentiate yourself from them. And then your sources and uses of funds. This is really important, because I talk to people all the time, and they know exactly what they want to do and what kind of business they want to have and how they want to grow it. And I say, okay, how much do you need to make this happen? How much do you need to get your business started? Well, I have no idea. And again, we can help you figure that out. But a lender is going to want to know, not only how much do you need, but how are you going to use it, and does it make sense? So in other words, don't tell me that you need $50,000 if you really need $100,000, because then you're going to be undercapitalized and your business isn't going to be successful. Don't tell me you need $100,000 if you only need 50, because then you're going to have more of a loan to pay back than what you're really going to be able to do. So that's something else that you want to be really careful to think about is how much money you need and where it's going to come from and how you're going to use it. And again, as I mentioned, these are all things that we can help you with. We can help you put together a business plan. We can help you figure out sources and uses of funds. We can help you do projections. We can help you identify some different lending options. So by all means, if you need help with any of these things, either as an existing business who is looking to grow or, bring on a new product or a new location or anything like that, or if you are looking to start up a business, come to us. Here's our website. You can sign up for counseling and we'd be happy to assist. And this is my direct personal information. You can give me a call or shoot me an email, and I'd be happy to set up a time to talk to you. And at this time, I am going to turn it over to William Furman with SBA, who is going to share with you some information about one of the best lending resources that we have out there, and one of our really crucial partners, which is SBA, and some of the different financing options that they offer. So William, I will turn it over to you.
Thank you. And let's see. I'm not sure what my computer just did. I'm having some technical difficulties. I am trying to tell you what, I'm going to have to, let me bounce back out and bounce in just really quickly. I apologize for this. But just as when you stopped, something happened on my end.
Okay.
So let me.
Well, real quick, while William's doing that and trying to get back up, does anybody have any questions about that part of the presentation that I can answer?
I have a question.
Sure.
Suppose you talked about real estate as collateral. Is this real estate that you own or real estate that you are making payments on? Does that make a difference?
It can be either one, honestly. Where the difference comes in is what the value of it is in terms of the equity that you have in it. So in other words, if you're still making payments on it, like say it's your home and you're still making a mortgage payment, that can still be taken as collateral. But what then the lender will look at in terms of how they value the collateral is, they will look at what it's worth versus what you still owe on it. So if it's worth $300,000 and you still owe $200,000, then they're going to value it at $100,000 for purposes of collateral, or maybe a little less. Sometimes lenders will go 80% or something like that. And the reason that's important is because most lenders, when they're looking at collateral, they are looking to get at least 1-to-1, if not a little bit more. So in other words, if you are borrowing $100,000, they're going to want at least 100 to say 110 or 120,000 in collateral. So they might then want to look at other possible things that could be used as collateral to make up that difference. But that's a long-winded way of saying, yes, you can use real estate if you're still paying on it, but it'll impact how much it's valued at. And I think William has gotten back in, so I will turn it back over to him, and then we'll take more questions at the end.
And one quick, somebody did, how do some startups become eligible for tax exempt status while they are starting and growing a business?
Well, so as far as whether or not you're tax exempt, that really is going to determine whether or not you file as a for-profit or a nonprofit business. So, if you file as a 501c3 or some other form of nonprofit, then you're going to be tax exempt. If you file as a for-profit corporation, you will owe taxes. But the other piece of that to bear in mind when you're thinking about it in terms of a startup is that you are going to pay taxes on your business net profit. So, if your doors aren't open and you're not making anything yet, then you're not going to owe any taxes until you start, at least as far as income taxes go, until you start making a profit. Now there's other things like, sales taxes and things like that work a little differently and but again, are based on your revenue. So until you really start making revenue, you won't really have a tax liability in that sense. But again, we'd be happy to sit down and talk with you about that further. Business structure is one of those things we often get questions about. What is the best structure that I could have for my business? Should I be for-profit, nonprofit, LLC, sole proprietorship? So we actually are working on putting together a workshop for later in the year to talk about that, but that's something else that we can assist you with as well. So, William, I will turn it over to you.
Thanks, Paul. Appreciate that. Sorry for the glitch there. I'm not sure what happened. You would think we would have it figured out by now, but just want to thank you for having me today. And we are going to talk about SBA lending programs. So Paul has kind of set the stage, given us the foundation of what you need to do to be prepared to make that application to your lender. And so SBA has programs that can help you actually get approved for the loan. In effect, is what SBA does. So, but first, let's talk just a little bit about the overall goals and missions of SBA. We like to say we help businesses start, grow, expand, and recover. And the way we do that is really through, number one, our counseling programs. And we do that through what we call our resource partners, which are the Small Business Development Center. I can't say enough good things about the SBDC. They do great things. They do great work. You found this webinar, so you're hopefully connected with them. And if you're not, I highly encourage you to do so, especially if you're seeking financing. Paul talked about what they can do, but that is one of their primary goals for SBA. So SBA helps provide funding to the Small Business Development Center so that they can work with you one-on-one at no cost to the business. And again, helping you with your business plan and helping you prepare that financial package and gain access to capital is one of the key measures that SBA looks at for the SBDC. Now, we do have some other partners here in Charleston. I just want to mention, we do have SCORE, and we also have a brand new Women's Business Center. And so those are two other organizations that can provide assistance as well. So that's the first thing, counseling. Then we provide access to capital for small businesses. And that's really the focus of what I'm going to talk about today, and go through some of our lending programs so that you have a better understanding of what is required and how they work, really. I think that's very important. We also have contracting. The government has a goal to spend 23% of all of its federal contracting dollars with small businesses. And so the government spends over $500 billion a year. It's the world's largest purchaser of goods and services. So it's a really good way, or can be a good way, for you to grow your business. Not necessarily a good way to start, but a really good way to grow. And then finally, we have our disaster programs. And so I think everybody, SBA was a secret 2 years ago. Nobody knew about SBA, but then we had COVID, and now everybody knows about SBA and the PPP loan and the EIDL loan. But we're that's really not that's not our focus. Okay, so those programs were developed to deal with the pandemic. But we have other programs. We have regular disaster programs. So when there's a hurricane and Charleston is declared a federal disaster area, SBA has low interest long-term loans that can help homeowners, renters, businesses, and even nonprofits with uncompensated losses. And not only can it be economic injury or a loss of revenue, but it can be physical losses as well. So if your home is damaged, if your business is damaged, SBA will be there to offer long-term, low-interest loans and help with your recovery. So just want everybody to understand the mission of SBA. All right, so Paul's already talked about this, but I can't let it slide either. So, prior to COVID, I was hard and fast on this, right? No grants and no direct loans from SBA. And so, I'm going back to that. We're in the very, very final or the backstretch coming to the finish line on all of our COVID programs. And so just to touch on that briefly, Monday is the last day to apply for a PPP loan. If you have not done so, honestly, at this point, it's going to be pretty difficult. Most lenders have stopped with the program and they're moving on as far as PPP goes. Now, if you have a PPP loan, you do need to have it forgiven. Once you use your funds, that loan, you're going to have payments coming due on that loan if you don't apply for forgiveness. And so it's a pretty straightforward process, especially for those loans of $150,000 or less. So you need to go ahead and start working on that. Now, the economic injury disaster loan is still out there. It will be available if funds are available until December 31st. One thing I've talked to some friends of mine, one thing to be aware of, you should have gotten an email. If you had an EIDL loan, you should have gotten an email with an offer to increase your loan. And so some people are finding or suspect that that's a spam email, and it is not. So that is an opportunity if you would like to increase your working capital through EIDL, be sure to check your email and follow the directions for SBA to do that. And so Paul covered it, no grants, and we really don't have direct loans. The only time we make direct loans is through the disaster programs. None of the business programs have direct loans. These are loan guarantees, and this guarantee acts as additional backing to the lender. Okay, so some people like to call it an insurance policy to the lender, but technically it's called a loan guarantee. Those guarantees range anywhere from 75 to 90%. And the way that works is that if the loan were to go into default, the lender would come back to SBA and say, hey, look, I had this loan on the books that had an SBA guarantee. I incurred a loss of $100,000. And let's assume it had a 75% guarantee. SBA would actually cut a check and pay that lender $75,000 on that loss, so that the lender only incurred the $25,000 or 25% of the loss. Okay, so it reduces the risk. It encourages the lenders to make loans to small businesses. So that is very important. That's really the whole foundation of SBA's business loan programs. And so the primary, our real bread and butter is what we call the 7A loan program, okay? And that is the 7A guaranteed loan program. And that's exactly what I was explaining. Okay, so it's a guarantee, and it requires a small business, it requires the lender, and it requires SBA. So you've got to have all three partners in this to make it work. And so let's say that you have the small business and they have a loan proposal and they think they have a really good idea and they're seeking a loan. And, maybe they contact SBA and we say, yeah, that looks like a pretty good idea. Looks like a good bankable loan. But then we go to the lender or the small business goes to the lender, and for whatever reason, they will not approve the loan. Well, at that point, it's not going to work because it takes all three. You've got to have all three partners. You have to have the business that is actually the loan applicant. You have to have the lender who actually provides the funding, and then you have to have SBA who provides that loan guarantee to the lender for these transactions to work. Now, a lot of people say, hey, I'm gonna, I wanna grow my business, I wanna start my business, and I'm gonna go to the SBA and I'm gonna get me a low interest loan. Well, again, it doesn't really exactly work like that. SBA's number one, SBA's interest rates are very competitive. In some cases, they can be very advantageous in low interest. Others, they may just be more competitive. But this is an important, I like to call it a spectrum. Okay, so this explains when a business would obtain an SBA loan. Okay, so on one end of the spectrum, you have your very most viable business. And so, you know, with that, you would have experienced management. You'd have great cash flow. You know, there's no issues with paying your debts. You have really good credit. Loan is fully collateralized, and maybe even, and then some, you know, over collateralized even. You have a really good business idea. You have a financial reserve. You have plenty of equity in that business. You know, that is a situation that business can go to really any lender and obtain a loan. They don't need SBA. So therefore, they are not eligible for SBA. Now, on the other end of the spectrum, you know, we have in the yellow, you have the least viable business. And so that's a situation where there's no management experience, there's no repayment ability, it's not a practical business idea, there are no financial reserves, there's no equity in the business. So in those situations, even with SBA, it is not bankable, and therefore SBA will not approve a loan, will not issue a loan guarantee in those situations. So we fall somewhere in the middle. We do fall in situations, or we cover situations where there is increased risk. Okay, so that risk can be a lot of things. It could be that maybe the cash flow is limited and the business needs a longer repayment term to lower their payments so that they will have adequate cash flow. That could be a good situation for SBA. Maybe it's a situation, Paul talked about collateral, okay? So maybe there's a situation where the business does not meet the lender's credit policy for collateral. That could be a situation, and that's honestly, that's probably one of the most common situations that we see where lenders come and request a loan guarantee. There's a collateral shortfall there somewhere. The loan is under collateralized, but has good cash flow. Okay, so if you have a shortage on collateral, you've got to have good cash flow to cover that. So that is a really big situation. You know, maybe you have a change of ownership, you know, so when you have a change of ownership with new owners come increased risk. That is another situation we see quite often. So, you know, it's really up to the lender to make that decision. Keep in mind that the business is the customer of the bank, and that the bank is actually the customer of SBA. So that is, you know, you need to look at these. Now going in, you should know that maybe you do have a collateral shortfall, and you know that up front. Maybe you do know that you need additional terms, longer terms, to make your payment more affordable and assist with cash flow. And so you're going to start looking up on the front end for lenders that actually participate with the SBA program. And Paul and his team can help you with that as you develop your business plan. You know, those issues are going to come to the forefront and come to. Okay, so how do SBA loans work? You know, you've built your business plan, you have your loan package with the help of Paul and SBDC. So now you're ready to apply with a lender of your choosing. Typically, you know, a lot of times that would be somebody that you already bank with, or Paul and SBDC can help guide you to an appropriate SBA lender, a lender that is actively doing SBA loans. Okay, so you go to that lender. The lender actually chooses the loan program or chooses to use SBA. They may go SBA. They may want to do it traditionally. You know, it depends on the strength of the business and the strength of your financial statements. If the lender chooses to use SBA, the lender submits to SBA for approval. Now, a few other things you need to keep in mind. SBA does not provide the loans. Again, SBA provides the loan guarantees, which act as backing. SBA does not have grants for small businesses. SBA does not set the interest rates. Okay, so that is actually negotiated between you and the lender. SBA does impose caps on those rates, and we don't allow lenders to exceed a certain limit, but you can still negotiate your rate with the lender. And then SBA cannot force a lender to approve a loan for a small business. It's entirely up to the lender. And yes, we do get those calls. It's not SBA's loan technically, it is actually the bank's loan. So we can't dictate to them, how they make the loan, whether they make it or not, or even the terms of the loan. So that is up to the actual lender. All right, so you do have to be eligible for an SBA loan, okay? So it does have to be a for-profit business. Got some questions there at the end about starting going down the nonprofit route, and SBA cannot make loans to nonprofits. It has to be a for-profit business, and it has to be a small business, and that's where the size standards come in. And so every business has a different, what we call NAICS code. That stands for North American Industry Classification System. And so every code has a size standard to determine what is small for that particular type of business. And it's either going to be based on the number of employees. So manufacturing is based on employees, right? And so depending on the type of manufacturing it is, they go up to 1,500 employees, and they still meet the small business definition. Other businesses are tied to gross revenue and the average revenue over 3 years for that business. And so just for example, a construction business, if they have a gross revenue of $36.5 million or less, then they would be considered a small business. So you have to be a small business, you have to be for profit, you have to be an approved type of business. Now, most commercial businesses are eligible under SBA. There are a few that are not. If you are some type of lending type business, you would not be eligible. If it's a business of a prurient nature, some people call it sin-based businesses. Those are not eligible under SBA as well. And then you have to be unable to borrow on reasonable terms. Okay, so that goes back to my spectrum, right? And so, we're not looking at a situation where you're, the only way you can get a loan is through maybe an online lender. In my opinion, that is not a reasonable term. And so just follow up on that a little bit. Just be very, very, very careful. If you start to go down that online lender route, you can get in trouble really quickly. In some situations, you're not able to get back out of it. So just be careful with that. But you have to be in a situation where you go to your bank and your bank says, well, I just can't do it under our typical loan policy. But maybe if we can get an SBA guarantee, we can make the loan. That's the type of situation that we're looking at there. Remember, there would have to be some type of risk or increased risk that you needed additional backing, and that SBA guarantee provides that back. So our 7A loan program, again, this is our bread and butter loan guarantee. The maximum loan amount can go up to $5 million, okay? So that is the maximum limit. Paul, commercial banks, a lot of them don't want to make loans of, say, less than $350,000. Some may not want to make loans of less than $500,000. But then we do have some that will make loans of $10,000. It just depends on the lender. But the maximum is $5 million. Now, loans up to $150,000, typically during normal times, and we're not in normal times, okay? So, but typically it would be an 85% guarantee, and then loans over $150,000, 75%. Now, I have a slide that talks a little bit more about COVID incentives, but I'll go ahead and tell you that right now through September 30, SBA is issuing loans or loan guarantees on all of the programs at 90%. So the lenders are only exposed by 10% for this year, and that is going through September 30. And then once we start a new fiscal year for the government, I fully expect that these will fall back to these 85 and 75% range. Now, that really doesn't affect the business or the borrower that much, other than it may impact the fees a little bit. This is really more of a big deal for the lender. So the larger guarantee that they can receive, the less exposure, and the more money they can make. So that is important to them. Terms. This is a very big one for small businesses. SBA can allow terms up to 10 years for equipment and working capital. Most conventional lenders are not going to do that. They're not going to go 10 years on equipment or fixed working capital. They're just not going to do it. Same thing for fixed assets or real estate. You're probably going to look at a 15-year term versus 25. If it were working capital, it could be 2 or 3 years. And SBA will allow that lender to stretch that out to 10 years. So that really helps, when you're doing your projections and you're looking to see what your payment is going to be for that proposed loan. If you can stretch that term out, it's going to reduce your loan payment. It's going to increase your debt service coverage, and it's going to help with cash flow. Now, interest rates, I think I already mentioned this, but interest rates are negotiated between you and the lender. And typically it's going to be tied to prime. Right now, prime is 3.25%. So that's going to give you an interest rate of about 6% on an SBA 7A loan. That's really pretty, that's pretty good. That's interest rates. I think we are seeing some pressure to push those up. We're seeing some indications that inflation may be coming back. So just keep that in mind if you're looking to undertake a project. I don't think rates are going to go down. If anything, they're going to go up. In SBA loans, also, the 7A program does allow for both fixed and variable rates. You may be able to get a little bit lower rate if it's a variable rate, but then that's up to you and the lender. And so that would need to be negotiated there. So, all right, fees. Again, these are typical fees. So you can just take a look at this. I'm not going to read all of this slide. And I know we're trying to keep this to an hour, but we're running over just a bit. But keep in mind, and I have another slide on this, SBA from now until September 30, we have eliminated or waived all the guarantee fees. Again, that's part of the COVID relief. And so it can make a difference. That's just a nice bonus when you don't have to pay say 3.5% of the guaranteed portion of the loan. If you were looking for a loan of $700,000 to $1 million. September 30, I do expect these fees will return in a very similar, may not be exactly this, but it will come back in a similar structure. So what are the benefits of an SBA loan to the business? And this really applies to the bank as well. It does allow for longer financing, up to 25 years on real estate. Okay, so interest rate, again, we do impose a cap on that. The lender can't charge over, normally it's tied to 3% plus prime rate, or 3.25% plus prime rate. Lower monthly payments. No renewals. This is another one that SBA does not allow. No balloon payments. So a lot of times what you'll see is a lender, maybe they will do a long amortization, but then they'll throw a balloon payment there at the end of 5 years, and they'll call the note due. SBA does not allow that. And we also allow for lower down payments. So again, that guarantee is reducing the risk to the lender. And so the minimum for SBA is 10%. You do have to have a 10% balance sheet equity, whether that 10% is injected in cash or not, or whether you have already injected that in the, and it's showing up on your balance sheet. Either of those situations will work. Now, it is up to the lender. Again, it's the lender's loan. They may require more. All right, so, you know, SBA may say, well, 10% is our minimum. Well, the lender may say, well, that's fine, but we're going to require 20%. Or if it's a high-risk business, maybe it's a restaurant, you know, you may be required to pay 30%, even 40%, you know, or have a 40% equity position. They may require that. So just keep that in mind. The lender ultimately dictates how that loan is going to be structured. So how can it help you? It can be used for a lot of things. It can be used to help launch, grow, or repair a startup. You know, startup is a bad word in lending circles, but we do see them done. And a lot of times, I mean, that's just another reason why a bank will want to use the SBA guarantee for a startup situation. It can help you purchase a small business. Maybe you have a change of ownership. You have the opportunity to buy out a partner. You know, all of those can be done using SBA, access or revolving line of credit, working capital for day-to-day expenses. We have programs for all of that. We can help you purchase, and renovate or expand your facilities, inventory, equipment, machinery, purchase land or real estate. We also have export loan programs available as well. So we're not going to be able to go into all of those details, but just know that they are available. And if you want more information on exporting, we can make sure that we get that for you. Okay, so that kind of wraps up the 7A loan program. And then the other program that we have is the 504 Certified Development Company program. Okay, so this is a program that is used for fixed asset financing. Okay, so this would be major pieces of equipment or real estate. You know, it could be maybe you have a building, maybe you're in your building and you've been leasing that for several years and now you're ready to purchase your building. This would be an ideal program to consider. It could also be used for new construction. It could also be used for major pieces of equipment. Okay, so typically not rolling stock, vehicles, those types of things. If it has wheels on it, SBA typically would not be able to do that, but fixed assets. And I call this a leverage program because it is financed by using multiple partners. Okay, you're going to have a commercial loan, and that commercial lender does the first 50% of the loan, and they're going to take a lien on the first 50% of your collateral. So typically for this program, it's going to be real estate. So they're going to get a first lien on the first 50%. And then we have our certified development company that is going to come in with a 504 loan. Okay, so SBA provides this CDC, certified development company, funding so that they can fund the next 40% of the loan. And then the borrower contribution is only 10%. So this is a really good deal, and it helps a lot. Again, it's used for long-term fixed assets. The real benefit of this is that the certified development portion, or the 504 portion at 40%, is a fixed rate, long-term, it is 25 years. And the current rate for that right now is about 3%. Okay, so a 3% loan fixed for 25 years. That is a great deal. You know, it doesn't get a lot better than that. Now you do have to factor in what we call the third-party lender. This is the commercial lender. They're doing the 50%. But even if you look at the blended rate, it is going to be very attractive. Okay, and so again, because of COVID-19, and so that just makes it even better. I can tell you that our demand and loan volume for 504 loans is very high right now, and the reason being is the interest rates are historically low. You've got these great incentives that are in place, and so businesses are purchasing. They're either expanding, building new buildings, using the 504 program, or they're purchasing, you know, maybe they have the opportunity to purchase a building that they're already in. Again, I already talked about interest rate or terms are generally 25 years for real estate. Again, you can finance equipment with a 504 loan, and those terms would be for 10 years. And so that's again, very, very attractive. And so, you know, I know we're throwing a lot of information at you. One thing I do encourage businesses to do is look at their options. Okay, what is my loan going to look like if I get a 504 loan? What's my loan going to look like and cost me if I go with a 7A loan? And then what if I go conventional? What does that look like? So, you know, fees, terms, interest rates, you know, put it on a little spreadsheet and then make a determination as to what is in your best interest. Now, I tell you, the biggest competitor for the 504 loan is the SBA 7A loan. And so the reason for that is that lenders like to do, you know, if they get a good deal, a good project, they want to do all of it. They want to do 100% of it, not 50%. They want all the profit. And hey, can you blame them? You really can't. So just be careful. I think, again, a good way is to make sure you do your homework, make sure that you see what each program can do for you and what it's going to cost you. So the maximum interest rates, they are fixed, established when the debenture backing is sold. And that's simply the function or method by which SBA funds the 504 loan. And again, those interest rates right now are about 3%, maybe slightly below 3. So it's just, again, really good deal. And then our last program I want to talk about, Paul did mention this, but SBA does have a microloan program. These are for loans of $50,000 or less, and they are to be used for working capital, purchase furniture, fixtures, equipment, supplies, and inventory. It cannot be used for the purchase of real estate. Okay, so that's one big difference. And it's only limited to $50,000. The SBA actually provides these funds to other organizations so that they can manage these small business loan programs or loan funds, microloan program. We see this used a good bit of the time for startups, and so they're not averse to making a loan for startup. They are a little less averse to risk in general. One of the requirements to obtain a microloan is that you have to be in a position where you cannot obtain a loan from a commercial lender at reasonable rates and terms. And so what we see many times is that a business, maybe it's a startup, maybe it's an existing business, but they have their existing lender, regular commercial bank, they're trying to obtain a loan from them. And the lender, it may be, if it's less than $50,000, as Paul mentioned, they don't have a lot of interest in that. There's just not much in it for them. And so they will make a referral back to a micro lender. Here in Charleston, we're very fortunate to have Charleston LDC. They are one of the most active micro lenders in the state. They have been actually doing micro lending longer than any other organization in the state. So they do a really nice job. If you're not here in the Charleston area, they do cover the entire state with the exception of the Greenville area. And so Community Works Carolina picks up the Greenville community, and then Charleston LDC covers Charleston. So those both very good lenders. And we also have Appalachian Development. We have the Small Business Assistance Corporation. They're in Savannah. Community Works, again in Greenville, and we have the Beaufort County Black Chamber, and they are in Beaufort. All right, I mentioned some of these incentives. Number one, Section 1112 payment assistance. This is still in play. This is part of the COVID-19 incentives, and this is basically what this means is that SBA will make, at this point, if you're getting a new loan, they will make 3 loan payments for you, principal and interest payments, when you obtain the loan. Now, if you have existing SBA loans, there may be some, you may or may not be eligible. It's a little bit complex process to go through if you have an existing loan. But if you don't have an SBA loan, you will have the ability to get 3 loan payments made for you just as an incentive for the COVID-19 programs. So great opportunity there. Again, all fees are waived through September 30. SBA increased the guarantee fee to 90 or guarantee to 90%. We didn't talk about express loans, but that is a 7A loan product. It's typically a smaller loan that SBA gives the approval authority to the lender. So it makes it really easy for them to make loans. That is typically capped at 350,000. SBA has increased that to 1 million. Now, one of the things that can be done with this is a line of credit. It's a really easy way for a lender to make a line of credit by using the SBA Express. And so now that's gone up to $1 million. And so that is really a nice incentive to the lenders, and it's helped small businesses as well. Again, all of these COVID-19 programs are subject to the availability of funding. So we don't know, we hope they'll last until September 30 for at least these, but we'll just have to see. Again, lending is taking off right now. I will tell you that. I already mentioned the 504 is above average. We fell behind on 7A for quite a while, but that's starting to take off again. So people are taking advantage of these incentives. Paul really covered all of this, but it is very important. And I kind of have to laugh and just tell you this. I get a lot of calls, people, they want their SBA loan, and I try to start getting some of the background from them. And one of the things I ask is, do you know how much you need to borrow? And they're inevitably, they ask me, well, how much can I borrow? And that's the wrong answer, okay? So you do need to make sure that you complete your business plan, complete your financial statements and projections, and know specifically the amount of the loan that you need. Another tool that SBA has is called Lender Match. This is a really pretty neat tool on SBA.gov. And this simply helps you shop your loan request out. And so SBA has a list of all the SBA lenders that are participating in this tool. And you go online, you describe your needs. I think there are about 20 questions. And then the SBA lender will reply if they're interested. They'll reply within 2 days. And it's really nothing more than it's just a matchmaker product. And so you'll get a reply back. You'll set up an appointment to talk to the lender. And then if both parties agree, you'll apply for the loan. It does not pull your credit report, doesn't do any of that. And so again, it's just a matchmaking product, but it goes out, depending on where you are, it goes out to 20 or 30 different lenders. Just think how long it would take you to make those phone calls and to get in touch with the right person at all of those banks. So it's a good way, it's a good tool. It doesn't obligate you to anything, but it does help you gauge lender interest. A few helpful sources. This is going to be shared, so I wanted to have you to have these links in chat. I did put SBA.gov has a tremendous amount of information. SBA.gov /SC has a list of lenders there that participate in SBA programs. So you can go and look to see what lenders do participate in 7A and 504. We also have the list of express lenders. So that's helpful as well. We do have, although it's been kind of crazy with COVID, I'm not sure if it's up to date, but we normally place our lender productivity reports on our website as well. So you can see which lenders are active in the program. And that can be helpful for you as well if you're that. This is my last slide. You do have my contact information here. And I will be happy. I think we're going to open it up for questions. We'll be happy to take any questions.
Thank you very much, William. Yes, that very, very good information. And so, yes, if anybody has any questions for either William or myself, we would be happy to take those.
So there is one question. How long does the processing of the EIDL, Economic Injury Disaster Loan, increase take? William?
Wow, we're not talking about that today, but I'll answer anyway. You know, there are millions of these increases being requested. You know, I'm seeing, assuming that there are no issues, 4 to 6 weeks. You know, if it's gone on past that, feel free to reach out to me. We can try to take a look at it and see if we can figure out or get an update, see if anything's going on with the loan. The South Carolina District Office does not have access to the Office of Disaster Assistance application system. So we are very limited on what we can see. But feel free to reach out to me after this, and we'll see what we can do if it's been longer than about 6 weeks.
Now, William, these increases are in conjunction with the invitation. Is that correct?
That is correct. You know, depending on when you received your loan, if you received your loan just recently, that would, your EIDL loan just recently, your loan amount would have been calculated at the maximum that there is. But if you obtained an EIDL loan earlier, you should have received an email with an invitation to apply for an increase.
And with that invitation, do you not have to meet 2 criteria? Do you have to click onto the map and be in that location?
No, don't confuse that with the advance.
Okay.
Yeah,
That-
so you.
And all right, perfect. I understand now. Thank you.
Yep.
So we don't have any other questions. Does anyone have any questions at all? How do you set up an appointment for counseling? That is a great one. Margaret, I will reach out to you after this is over, and I will share with you the closest Small Business Development Center office to you and give you a list of the names of the consultants in your area. Is there anyone else? You're most welcome, Margaret. Well, if there aren't any other questions, I'm going to thank the 2 gentlemen that presented today and thank Robert Jones, who is also here in the Charleston Area Small Business Development Center, and we will complete the presentation. One last thing I would like to mention, Robert and I will be sending out a post-event survey. We would like you to respond to that, and those people that respond will be receiving the slide presentation of today's webinar. So thank you again, and everyone enjoy a wonderful Memorial Day weekend. Thank you.
Thank you.
Thank you for having me.